You're welcome to the Economy and Politics Conversation. I'm Ottoabasi Abasiekong. This edition will discuss Nigeria's 2025 inflation outlook, implications for businesses and households. Joining me virtually for this conversation is Mr. Gospel Obele, Chief Economist at Streetnomics. It's great to have you on the program, Mr. Gospel, and Happy New Year.
Happy New Year to you, Otto. Thank you very much for having me. It's great to speak with the ProShare family again. Wishing you a prosperous one.
Thank you very much. Same to you. Let's begin by asking for your review of inflation rate in the year 2024. It was quite incremental, and the data from the National Bureau of Statistics released last week showed that it grew to 34.8%. That's for December to end the year. And for you, what were the key issues that stood out in terms of this rising tide of inflation?
Yeah, thank you so much. I have always maintained that the Nigerian inflation is, with the current play right now, almost designed to rise. I'm saying that confidently because, when the year started, we were barely at 30%, and when the year ended, we were about 34%. And don't forget that the central bank was also on the narrative of raising interest rates, up to about almost 800 basis points in the last 4 years, with a goal to try as much as possible to bring down inflation using interest rate as the instrument to take down inflation. However, we've seen that has not really yielded any form of result, in the Nigerian economy, even though you may argue differently that, rising interest rates may have brought down inflation. What we've seen across board globally to start with is that whilst inflation may have come down, cost of living crisis has gone up. Rents have gone up, cost to fuel your car has gone up, cost of energy has gone up, cost of food, most importantly, has also gone up. Incomes, disposable incomes are shrinking really fast. And that's also the situation in Nigeria. However, the reason why the Nigerian dynamics has been different when it comes to inflation, interest rates, has been because for very volatile economies like Nigeria, also in the West of some sort, where our inflation is very productively woven, meaning that we have imported inflation to deal with, we have a very low productive economy. We are in a situation where our inflation is not just monetary, so to say, and which is also the global argument. Inflation is not just monetary any longer. It is now systemic, it is now structural, it's now geopolitically informed, and all that. And when you weave that into the fact that Nigeria is a strongly dependent economy, not just imports now. It's a strongly dependent economy on Western events, Western engagement, Western imports, and all that. Then you see that the route through which inflation permeates into the economy, is way much more than the money. That is way much more. It has more to do than just monetary. You also juggle the conversation, the fact that exchange rate has been very bad, and there is a rising interest for the dollar, and even the Nigerian economy has been dollarized of some sort. What that technically means is that there's a lot of internal pressure on the currency, which has also increased the price of goods and services. All right. So the more notes you require to exchange the naira to the dollar, the more things generally get expensive. So the equivalent price point has increased. So if you look at all these things, it tells us that the Nigerian inflation and even African inflation, even the same thing for the Ghanaian economy as well, is slightly tilted different because it's structurally woven. It is productivity woven as well, and all of that. So, and as such, I don't really think inflation would come down by virtue of just monetary tactics only. You would probably require not just monetary and fiscal, but a wider systemic overview of how we plan to deal with inflation. So I wasn't surprised that the numbers are where they were, or where they were in December, and we are also having the same conversation now in 2025.
Well, you've already set the pace for the 2025 conversation, and we're asking your outlook for inflation. Let's look at the businesses first, especially SMEs. Small medium enterprises are the heartbeat of our economy. What is the outlook for them?
Well, the outlook for SMEs in the Nigerian economy is, I'll say it's a mix. If you start with the positives, the Nigerian economy has, grown resiliently. And whether we like it or not, it's one of the most entrepreneurial landscape in the world. So that's to say that entrepreneurial energy, entrepreneurial prospects, entrepreneurial access to fund and all those things, are really out there. So the promise of businesses being able to succeed within the Nigerian economy in terms of being able to scale as well is really there. But then again, businesses have to probably look at the landscape differently, because the consumers you sell to are strained by the cost of living crisis. So how do you sell to a consumer who is already trapped in the increasing cost of living? How do you work with corporates? How do you work with governments and all that? So the economic terrain may not be so favorable, but the prospect to win is equally as favorable. But then again, takes a different lens, different strategy, different tactics. It could probably be a game of probably looking at a different market entirely. It could be a game of how to rework your product, market, or service fit. So that you are speaking or connecting with markets within Nigeria, I mean, that have increasing capacity and potential to pay. And for some businesses, it may just be an opportunity to sort of shut down on that sector where you're playing in and look at sectors that are not exposed to inflation. For some businesses, it may be a complete review of your entire processes and look at how you can leverage technology more to serve your clients and stay more lean on costing and all that. So if you look at all the dynamics of management, market penetration and all that, there are prospects for the average Nigerian business. However, for businesses that are exposed to inflation, which a significant number of MSMEs play in, a lot of MSMEs play in retail and FMCG space, and all of that. That market in itself, that industry in itself is exposed to inflation. All right. So lots of businesses run the risk of losses. They run the risk of smaller profit margins and all that, which is why I started with the need to look differently if you want to be able to scale your business in 2025. Because as much as you say, oh, people will definitely eat, will definitely transport themselves, they will definitely find access to basic necessities. Also understand that there are many brands who are trying to play in that space, as well as you have a lot of competing propositions, which also makes the journey quite tricky, for MSMEs, especially for nano businesses. So it will be to look differently, act differently, interact with markets differently, and find increasing market spots to scale. For instance, the average person who earns 20,000 naira in Ibadan is richer in disposable income than the average person who earns 20,000 naira in Lagos. So, but if you think of the Ibadan consumer as a single consumer, that's where you want such a business may be making a mistake. So, you want to think of the Ibadan consumer as a scale of the Southwest cluster. How do you sell and push your products to the Southwest region? Which markets will give you the highest disposable income spread to connect with and all that? So these are part of the intricate questions. But then again, there's a gross lack of entrepreneurial education and how that entrepreneurial education can be scaled to actually help businesses succeed beyond just business principles.
Yeah, very, very, very well stated. Now, when we look at the households, they are very important components of the economic reforms carried out. ProShare, we take very seriously households and how they fare in the whole analysis that we do. It has to trickle down. And inflation, like we rightly assessed, is currently at 34.8%, and food inflation 39.84%, almost hitting the 40% mark. Households have been really, really hit. Their purchasing power is really affected. They're being squeezed. Incomes, minimum wage is 70,000 naira, and you know that is very challenging, even despite that increase last year. How do they navigate this phase of a high inflationary environment?
Well, it's quite tricky, and how can households navigate? Number one, households need to understand that they can't control the expense side of their financials or their finances, because those expenses are driven by externalities that households themselves don't have a control over. Externalities like government policies, externalities like exchange rate, externalities like an import-driven economy, externalities like more aggressive consumer behavior, and all that, which is also influencing some form of price hike. The fear of what the exchange rate or what the market can be in the next 3 months is also making people increase prices. All right, so it's not just the reality, it's also the perception of what the reality can look like in a couple of months. However, for the households who are intentional about staying above the waters and flourishing in 2025, they need to begin to think of what they can control. And the only element you can control in this context is your income. Your income is, how you make money, how you scale that and all that. So, and we don't do much of that. If you look at all the financial literacy classes, a lot about managing expenses, budgeting, cut down, saving, investment. But how do you actually get to a point where they can see opportunities, tap into this opportunity and raise your income? If you can raise your income, you definitely be steps ahead, because you can't control the bits that impact on your expenses. So I will encourage households to begin to look for alternative streams of income, and particularly a play in sectors that are inflationary proof. whilst the food sector is good, if you want to do anything within the food sector, ensure that it's technology driven, ensure that it's agri-tech driven. Leave the context of trying to, you see a lot of small businesses who do food businesses, who do small shops and all those things. Those kind of sectors are very exposed to the prices of raw materials, price of onions, price of tomatoes in the market. So if you want to play in that kind of market, you want to start thinking ahead of what kind of strategic food business, or how do I play in the food sector that can make me much more, advanced or ahead of inflation dynamics. So I would say households should begin to think of ways to, earn multiple streams of income, which may sound like a normal thing to say, but within all of that is the tactics to identify opportunities, to take advantage of opportunities, and to position yourself ahead of the inflationary curve.
Well, Gospel, not just you saying this, but this is really an emphasis now, because even Web TV, when we had conversations with Nigerians towards the end of the last year, they all talked about diversifying income. I mean, you have to just balance everything. You've talked about rent costs is there, transportation, feeding. Those are like 3 drivers already of your income. So it's really important that households, like you rightly said, will begin to look at creating value and diversify. So a lot in stock for the year 2025. But from the policy standpoint, like you rightly said, households will be affected by external policies and those things playing, like you've talked about exchange rates, very key issue. ProShare in its research as in work says, if we can address foreign exchange challenge and even achieve foreign reserve adequacy alone, it will address 60% of the inflation challenges we are facing in the country. But from a policy standpoint, how should fiscal and then monetary policy authorities approach addressing the inflation surge, which you've described as a structural effect in terms of its impact?
Well, yeah, thank you. It's a very brilliant question. First off is the fact that we underestimate this a lot in Nigeria, but I think people know about this, but it's what it is. Many times the quality of synchronization or working together between the fiscal and the monetary end is a lot of times a function between, the two heads of. So here you're talking about the president, the minister of finance, probably the minister of trade and investment, and the central bank governor. So if you look at that dynamics already within the current Nigerian landscape, it's sort of a plus, because there is a perception that you have that relationship across those strategic heads of, now that's a leverage, to ensure that monetary and fiscal policy synchronization happens. But however, even if you say that's a leverage, that's one thing. Now, that's the necessary condition, but the most sufficient condition is the nature of policies, that are being birthed out of that synchronization. And that's why I think Nigeria is sort of missing it, because in previous governments, we've not had enough synchronization at that level. But now we have that opportunity, but we need to get it right on the policy front. And now that policy front would technically mean that whatever is being rolled out have to factor in all of the moving parts of inflation, or all of the moving parts of that policy. I mean, in terms of, when you think about the policy, there are different components that make that policy a success or a failure. The timing, the approach, the policy itself, the delivery structure and all of that. So every element of a policy has to be strongly considered in terms of how they help us achieve the goal, the particular set goal of bringing down inflation. So in this context, we talk about policy coherence and policy consistency. So, and sometimes it's not just a thing of whether the fiscal or monetary authorities are working aligned enough. It can also be that they've lost track, or there's some form of pressure. And that's one of the things I sense about the current administration. There's a lot of pressure to make things work. And as a result, there's a lot of policy jam and policy inconsistency. So I would say that a lot more consultations should happen. More, as much as it's political will, there has to be a strategic use of data to understand what is really going on at the base level, and begin to develop policies that are more structurally reform in approach. I mean, more structurally influencing in approach, and ensure there are clear ways to be able to track, measure, and deploy those things effectively. So yeah, so for me, I think that's one of the missing things. So if we think about the floating of the naira, the fuel subsidy and all that, there's a lot of policy inconsistencies, lots of policy misalignments. When you think of the student loan coming side by side with rising interest rates, that's also a policy misalignment, But the central bank governor, the Minister of Finance, the president are very, very close. You want to expect that leverage should also lead to some strong sense of alignment. So it's also a thing of not just being close, but also bringing institutions together at that level of alignment, so that when you're introducing a student loan, that's not the best time to increase interest rates. When increasing interest rates, that's not the best time to introduce a student loan. So there has to be a sort of relief intervention around our policies as well. So whatever policies you're introducing, how are you also ensuring that there's relief for the people who would be experiencing the effect of those policies, either positively or negatively? So I think if we can consider development in this area, which has been one of the major spaces where we've lost touch and coordination on, we might be able to make some significant progress in terms of bringing down inflation and actually managing the exchange rate dynamics.
Thank you very much, Mr. Gospel Obele, Chief Economist, Streetnomics. I mean, you've given us clear insights on what has to be done. Businesses have to look at the exposure, especially those ones exposed to inflation. They have to work on it. Households have to now look at diversifying their incomes and create more value, invest more in skills that will boost their income. And also, you've talked about policy, that we are seeing for the first time, the fiscal and the monetary, there seems to be some relationship. So that opportunity needs to be harnessed. So we have policies that address structural issues. I like what you said, that things have to go side by side. Let these things align properly. And maybe there's one study now globally, Professor Javier Milei, the economist in Argentina, hopefully we will see the inflation begin to reduce. I don't know how he has done it, but that's something to study. But in just 1 minute, do you think we can achieve that 15% inflation target this year?
I don't think we can. I think it's we being ambitious, not because we can't. We can if we want to, but to bring down that, we need a productive economy. We need a productive economy because the drivers of inflation are very structural. So if you're not dealing with those structural elements that are imputing into the inflation, whatever policies or interest rates you introduce will not bring down the numbers. Now, although there's a rebasing argument, that might really work, and hopefully we have the right items in the right baskets at the right weighting.
So correct weighting.
We have all that dynamics. If the numbers in code may drop down, but I still don't believe that it will be a clear representation, because 60% of the Nigerian economy is informal. So how are you even capturing that in your analysis net to say that this is what? Because if you want to know the actual inflation numbers, get on the streets. There should be a street inflation index in Nigeria that actually tells us what the reality of things are. Laptops, phones, and all those things are hiking every day in terms of prices. So will the new rebasing formula capture the reality of the streets, of what's happening in computer village, of what's happening in the oil and gas industry, all of those dynamics of how innovation, AI, and all of these things are impacting the market for gadgets, devices, and all of those things. So these are frontline commercial. Unfortunately, our regulatory practices, our measurements, and our tools are still years behind. Even if you base today, the thinking of those methodologies are years behind. So I wonder how we need to come this far in our inflation analysis. And if you look at the basket, there is not enough representation of technology, equipment, and all this. And those things are a major driver of inflation. If you go to buy a laptop today, it's going to be a different price in the next 2 weeks. All right. So it's not just the methodology, in as much as you want to catch up. It's also the nuance about how those methodologies are fit within your economic realities. If 60% of your economy is informal and those prices are woven by industry, manufacturer behavior, importation behavior, exchange rate behavior, you need to be able to factor in those variances, or what we call as error terms in your rebasing methodology. So I don't want to go too much into that, but
of course, a lot to look out for in the year, but like you rightly said, it has to be realistic. Thank you, Mr. Gospel Obele, Chief Economist, Streetnomics, for this very insightful conversation on the inflation outlook for 2020.
Yes, sir.
We hope to talk more much later in the year to see how it's going.
We should. Looking forward to it. Thank you very much, sir.
Thank you very much. Thank you. Thank you.
To our viewers, if you want to get further insights on this conversation on the inflation outlook for 2025, visit the ProShare website displayed on the screen and follow our social media platforms to engage on this program. Until you come your way again, enrich yourself with knowledge of socioeconomic developments around you. It is wise. I'm Ottoabasi Abasiekong. Thank you for watching, and bye for now.